All right, what's up, everyone? In this video, I'm going to be going over liquidity, how to find liquidity, and what is liquidity, and how you're going to be using liquidity for then your trading. All right, so this concept is very important because it basically, when I start talking about my strategy, uh, this is something you really need to understand for my strategy to make sense to you. This is why I'm going to be going over this, and then next video I'm going to be going over IFVGs, which is inverse fair value gaps. And those are all components that play into my strategy, but without you first understanding these, then my strategy is going to make zero sense to you. All right, what even is liquidity? Liquidity is basically certain points, certain highs and lows in the market where a lot of orders are being held at. So, for example, at a high, at a very obvious high, you're going to see like there's going to be liquidity above that high because people are going to be placing um, their stop orders above that high. And liquidity is basically just like a bunch of orders so that the market movers, the big institutions, can then fill all of their orders. So, in other words, the market moves to where liquidity is. Like the market's always at a constant movement, it's always seeking liquidity because liquidity is what helps it move. Think of it like this. Think of the charts and the candlesticks and all this as a spaceship, right? So once, like, for it to go lower, it first needs to reach a certain point to sweep liquidity. So for example, like here, like in this move, the market basically moves up the points of liquidity so that it can fill orders and move in the opposite direction to then target liquidity to the downside. Like right here, you see it goes down, down, down. It sweeps this obvious liquidity where there's going to be a lot of orders under. And then it uses that as momentum to then go back up. Now, you can't use this as like a strategy or anything. This is just a concept you need to understand because it's how the market moves. You have to think of it, the market is moving to always seek and liquidity so that orders can be filled. All right, now that hopefully you kind of have an idea of what liquidity is, um, now you want to know where you can find liquidity. So liquidity can be found at most highs and lows in the market. But the ones that are important that you should actually be paying attention to and actually using and understanding are I'm going to write them down. So there is equal highs, there's equal lows, and there's low resistance liquidity. Now, what do these three things mean? So, equal highs are basically 2 points in the market separated where it's two equal highs, basically. So 2 points in the market where it stopped at the same point, like the same high. And there's actually a good example right here. So here we actually have um, yeah, I'd say this three. So three equal highs. Now, the majority of the time, the market is going to want to come up and sweep these because it's a major point of just orders above this. So here, for example, I would never short because of these equal highs above. You should never short when there's equal highs above and never long when there's equal lows below. Another example of equal lows right here. Right here, there's two equal lows. You see how it creates a low here, goes back up, creates a low at the exact same point. Like this chart is, like for example, here's at 21,206.50. What are the odds that it makes the same low at the exact same price at 21,176? It's not a coincidence. This goes to show that there's liquidity down here. And what does market do? Comes down, sweeps this liquidity before making its move up. Now here, obviously, it didn't sweep these equal highs before it went down, but that's because other market conditions play into this that can cause this not to work sometimes. Now, what's low resistance liquidity? So low resistance liquidity is basically points where either highs are being made in a row but going lower, or lows are being made but going higher. So what do I mean by that? Let me find some low resistance liquidity. All right, right here. So I would say this is low resistance liquidity. Why? Because as you can see, it's following this trend line, right? And most people that trade with lines and trend lines and just like stupid drawings that they don't actually know what they're talking about. They're just drawing lines and seeing it's touching on the same point and making a pattern. Now, why would you want to target this? Well, because most people are going to buy every time it touches this line. But you want to do the opposite of that. You want to catch an opportunity where you can enter short and then target all of this liquidity down here. Because this is like very low resistance. Because like people are just trading on this line, but eventually it's all going to get swept, which as you could see, it did. It all got swept. And then here's an example of low resistance liquidity again, but this isn't that great, but it still works, I guess. To the upside. Now, as you can see here, what did it do? It came up and it swept all of this low resistance. And obviously not every time this is going to happen where you see it starts creating a bunch of low resistance liquidity and then like it's not for certain that it's going to sweep it right away, but it is going to sweep it eventually. And then that should be points of interest that you should go on your chart and study and look at, because a lot of my rules that I have in my strategy are based around, as I said, liquidity and equal highs, equal lows, and low resistance liquidity. Like for example, I don't take shorts if there's equal highs above. Why? Because I know that market will want to take out those highs before it goes back down. And same to the downside. I'm not going to take a long when there's equal lows below, because I know that the market is more likely to first go down, take that liquidity, take those equal lows before going back up. So it's like, even if I see my strategy play out and it's a valid entry, the fact that there's equal lows below makes it invalid, because it just makes it more low probability, because the odds are is that the market is going to go down and sweep that liquidity. Now, liquidity can get a bit confusing fully understanding it. And that's why I recommend you should just focus um, on looking for equal highs, equal lows, and also relative equal highs, relative equal lows, which is same thing I was talking about, but it could be off by a little bit. So I'd say these two, like these two, are relative equal highs because they're not at the exact same point, but they're close enough. Now, another way to use liquidity is by looking at internal liquidity. So, what do I mean by that? Most of the times you're going to be looking for these equal highs and equals lows on higher time frames. So your 15-minute, your 5-minute, your 1 hour time frames, you're not going to be placing your trades in. But for those of you that do place your trades in the 1 minute, which I do, and I place my trades in the 30-second as well, I target internal highs and internal lows as points where I want to either take profit or set my stop loss. So for example, right here, let's say whatever I entered here, right? I would set my stop loss at this inner low that's formed. Then I could either just target this internal high, or I could use this internal high as a break-even point, where once price reaches that or goes above that, I set my stop loss to 0. So I'm basically risk-free in this trade. And this is going to be something I'm going to be going over in another video, because knowing when to go break even, when to not, it does get confusing. But I'm just saying that as an example of how you can use liquidity and internal highs and lows as points where you could set stop losses and take profits. So why would you want to set your stop down here? Well, you want to set your stop down there because if market, let's say you're wrong about the bias and you think it's bullish, but it's actually bearish. If market's actually bearish, it's going to want to target this liquidity, right? So you set your stop there because by setting your stop here, this means that, okay, if market does go down to try to take this liquidity, then my bias was wrong, right? Because then that'd be a bearish reaction. But when you create your bias and let's say you start the day, you think market's going to be bullish or the next hour is going to be bullish, then that's when you should target high points of liquidity. Because, for example, let's say we had these equal highs right here, right? Yeah, you guys can see it. We had equal highs right here. This would be a point where I would set my take profit. Like on any trade, you do not need to catch the whole move. You should be happy with a piece of the pie. Like, you can't be greedy and be like, no, why didn't I not hold all the way to here? Well, first of all, because you're not a genie. You're not a fortune teller. Like while price is here, you had no fucking idea that it was gonna go here, right? So that's why you need to set it at points where the probability of price going down after it hits that are high. Because you don't want to say you take profit at a point where, like a random point where once market crosses that, there's no need for it to go back down. Like that doesn't make sense. But what I was talking about, equal highs, market will target these equal highs to then be able to go lower, right? Because as I said, there's liquidity above these equal highs. So you would want to say your take profit at the same level as these equal highs, because like here, it didn't do it right away. But a lot of the times, once market reaches these equal highs, what's it going to do? Fill orders, go back down. So using equal highs and equal lows to set your take profits are a very good way. Like it is a very good way to set your take profits, because it's points where market's most likely going to reverse. So it's like, why wouldn't you want to set your take profit there? If odds are that market's going to go in the other direction. All right, that's going to be it for this video. Hopefully you guys kind of have an idea of what I was talking about and what I meant by liquidity and equal highs, equal lows. It is a bit confusing. It's something that you'll definitely be able to understand more through screen time, through just watching price move. Like I wouldn't expect you to fully understand it after this video, but hopefully you have like an idea of it that then you can use to help you understand it more when you start practicing it and looking for it on the charts. Um, my next video is going to be about IFVGs, which is the confluence I use to execute my trades. And then I'll be going over videos on how I'm able to put this all together to then execute a trade. Because with IFVGs, like it's not like you take every single IFVG you see. And it's fine. I'll go over that in the next video. But yeah, hopefully you guys were able to understand liquidity a bit more and get an idea of it.